like to start off with an article from Investment News that focused on the performance of emerging hedge funds. Now, this sort of delves into the topic of the fuzzy math that's involved in finance, and there is plenty of fuzzy math that's going around, often to the detriment of investors. And it's not exclusive to hedge funds also, because it's basically going on everywhere. Mutual funds are no exception, and I'll go through that a little bit more in depth. So it says here, emerging hedge fund managers are getting more attention from institutional investors because they tend to produce better returns than larger, more established funds. But industry insiders disagree about the extent of the outperformance. So basically they're saying these newer, smaller funds tend to perform better than the big funds. What could be going on here? Now, on one end, it may look like these small managers, these up-and-coming guys are very talented and they really have an eye in the market. However, may not be the truth there. So it says, hedge fund investment consultants and early-stage fund of hedge fund managers are critical of industry-produced and academic analyses that don't correct for survivorship and backfill biases found in the various public databases that aggregate self-reported hedge fund returns. They contend that statistical studies, including these two biases, produce artificially high returns for small, young, and large hedge funds. The thing is, especially with hedge funds, is if they do well, then everybody looks good, get as many investors into it as they possibly can. The issue is that when a hedge fund doesn't perform well, what they do is they shut it down and start over. So it's a great way to reset, a great way to start again with a clean slate. But then again, how great are those fund managers really? Because if they do well, they keep the fund open. If they don't do well, they go ahead, shut down the fund, and start over, which could take the actual performance very far away from what they're actually producing for investors. To describe these biases that were mentioned earlier, they go on to say that survivorship bias is introduced into a hedge fund database when a fund closes and its track record is removed, resulting in improved returns overall because the database tracks only successful funds. Something that occurs also in the indexes. People look at a chart of the Dow Jones or the NASDAQ and they think, wow, these companies, they just improve and they grow. These exchanges never seem to go down over long periods of time. And many people assume that these are the same companies within these indexes that are producing these gains over long periods of time. And nothing could be further from the truth, because essentially what an index does is it keeps the best companies listed and it delists the ones that don't do well. So all the companies that go bankrupt, all the companies whose stock drops below a certain level, they're simply delisted. So in essence, indexes are rigged to rise, for better or for worse, because they simply replace the companies that are within a particular index to track the best companies in whatever industry that index happens to follow. So there's also backfill bias. It says it occurs when a hedge fund includes past performance in its first report to a database. So you'll have a fund that's been doing well over a long period of time, and those are the funds that get introduced into these databases, which make the overall performance look that much better. So in this article, they say that the combination of survivorship and backfill biases accounted for 718 basis points of the 14.88% annualized performance for the 15-year period ending December 2009 of 6,000 some odd hedge funds. Now what they're saying there is basically half of the returns of the 14.88 annualized performance were based on these biases. So you'll have funds that were shut down and their returns were basically taken out of the calculation. And also you have funds that were introduced suddenly into the database and their past performance has been taken into consideration, which inflates the overall performance there. So basically there's criticism of how these calculations are made, which makes the overall performance seem that much better. But hedge funds aren't the only perpetrators of this. When a mutual fund company starts a series of funds, they do so with seed capital. So let's say ABC Fund Company wants to start up 5 new funds. What they're going to do is they're going to take, let's say, $100,000, $200,000 of their own money and put it into these 5 funds. And they're going to see how they operate over a short period of time. So they're going to give it maybe 6 months, maybe 8 months. And what they'll do is they'll see the performance after a certain period of time. So let's say 2 of the funds did very well and 3 of the funds didn't do well at all. What they'll do in that situation, quite simply, is they'll shut down the funds that didn't do well, and they'll keep the 2 that did well. So those 2 are going to be put into their disclosures, and that's what investors are going to get to see. They're going to get to see the funds that have survived long enough and have done well enough that they were not closed down or merged into other funds, so on and so forth. So in that respect, there also is a bias in the mutual funds as well. Now, what was particularly striking to me when I was auditing some funds right after the financial crisis, when things were starting to bottom out and consolidate before stocks went back up, what I saw was that a particular mutual fund company, what they did was they felt that the market was bottoming out, so they said, most of our funds have done horribly. What can we do about this? And I have to give it to them. They were pretty clever in this respect. They said, we've had 30% losses, 40% losses. How can we make this disclosure, which is the listing of all their funds and how they did or the performance and so forth, how can we make this look great? And what they did is this. They started, right when the market was at the bottom, they started 5 new funds. These funds, like I said, started right after the financial crisis. So the only way they can really go is up, especially after the losses we experienced in 2007, 2008. So, of course, these funds, if you looked at the charts, it's just a straight line all the way to the top. It starts at almost nothing, and then it just increases, it looks like exponentially. And this particular mutual fund disclosure had about 80-something funds, and it was over 1,000 pages. So where do you think, if you were to guess, that they put these 5 brand new funds that just opened a few months earlier? They put them right at the front of the disclosure. Now, forget all the other funds that have been open for 10 years, 15 years, 5 years. No. Nobody wants to see that because the chart looks awful. It'll make people cry. And they know this. They know that people don't read 1,000-page disclosures. They just don't. They'll look at the first few pages, get an idea, close it, and never open it again. So they kept this in mind, and specifically, they put those 5 untested funds that just happened to do well right at the front to get the attention of their investors to make them look a lot better. But if anybody actually looked past those 5 funds in the beginning, they could see that their returns were quite disappointing. So fuzzy math is very much an interesting topic, and it's not even exclusive to funds. I'm sure people on the call have noticed that when you take out a mortgage, you're given the APR, which is the annual percentage rate. That's the interest rate that you're going to pay. But it doesn't take into consideration compounding, of course. So when you have to pay it, they'll give you the APR, which is generally lower than the annual percentage yield, which is the APY. An annual percentage yield tells you exactly how much over the course of a year you're going to be paying, including compounding. So it's a much more accurate number to show you what the cash flow is going to be at the end of a certain time period. So when they're giving you a mortgage application and there's an interest rate, they'll always give you APR. But when you have a savings account and they owe you interest, suddenly they're giving you APY. So when you have to pay it, they want the rate to be lower, they use APR. When they're showing you the rate that they have to pay you, they use APY. It's quite clever. I mean, it works out very well for them. So those are just a few examples of some things to watch out for. Even when you have numbers in front of you, it really helps to delve into it and see exactly what you're getting, and to also look at it objectively and say, okay, what kind of message do they want me to get, and what kind of message should I be getting? And the difference between those will show you how many games are being played with you. And as an example, I just wanted to show everybody on the call the fuzzy math that can be done in finance. So let's say that we start an investment of $100. Okay, so I'm going to use extreme numbers for this example just to make the point. Let's say your first year's return is 100%. You did great. Let's say you got in those first 5 funds that were opened in those mutual funds, and you made a killing. So you went from $100, you made 100% return, and now you're at $200. Okay, next year does horribly. We have a financial crisis, negative 50%. So we lose half of our investment. So we start at 100. First year's return is 100%, where we were at 200. Second year's return, we lost 50%. Now we're back down to 100. The question is, what is the average return over these 2 years? Now, looking at it, people would say, okay, well, first year's return was 100. Second year's return was negative 50. Take the average. What do we get? we get 25%. So this is one way that finance tends to play with people, and there's a tendency in the markets for investors to take annualized returns, average them together, and figure that that's what they're going to be making within a certain time period. And it's just not the case. This gives you the arithmetic return, which is this 25% that we have here. The more accurate assessment of what the return would be geometric return, and that's what really investors should be looking for. Geometric return involves a formula. I don't really want to I have a no formulas policy for these talks because I know it tends to make people turn the call off. So that's just one thing to keep in mind. If you want to learn more about it, you can definitely Google geometric returns, and it'll show you exactly what the formula is, and it'll definitely give you a number that's closer to what you'll end up with after a certain period of time. As this example shows, it's not prudent to just average returns together, especially over time and when numbers are this big, to try to estimate what you're going to get at the end of your investment.